Either you are a financial investor or a strategic partner, it will significantly affect the way you are going to make the money from an M&A deal. As mentioned before, strategic partners are long-term driven, focused on exploiting potential synergies. On the other hand, financial investors are focused on a 3 to 5 years time horizon and price difference, where exit strategy is the key. Regarding strategic partners, in order to exploit potential synergies, they are focused on finding a complementary target and strategic fit, while financial investors pay more attention on timely market positioning, meaning entry, massaging cash flows, and finding a proper buyer for the exit. Let's explain potential synergies first. As mentioned before, they are usually created at the cost side, while it might come from revenues as well. On the cost side, the most common synergy sources are coming from manufacturing, marketing, and sales channel utilization, logistics, procurement, R&D, and administration optimization. Manufacturing. Here, you can find few sources to increase capacity utilization, to eliminate overlapping capacities, or to move or concentrate production at a place with lower costs. Here, the point is to concentrate the production process in fewer production facilities in order to increase their individual utilization rates, while you can sell the remaining, or overlapping, capacities. In addition, if the production units are placed in different countries, you can choose to relocate your production at the most cost-effective place in your just-enlarged portfolio. Simply, some countries have lower labor costs. Production facilities might be closer to main suppliers or customers and similar. This type of activities can produce cost savings either at a target company level or both companies, depending where you apply changes. In addition, you can acquire a specific target company that will extend your value chain, meaning to provide you a production unit or a resource base and help you to eliminate your supplier. Marketing and sales channel. Here is the point to better utilize sales channels, for example, through cross-selling activities, reducing overlapping sale points, and similar. In addition, based on increased negotiation power and better brand management, marketing-related expenses might be optimized. Logistics. Here is the point to better utilize logistic capacities and transportation routes, optimize inventories, and eliminate overlapping capacities. Procurement. Here is the point to exploit increased negotiation power and reduce input costs. R&D. Here is the point to join talents or experts, eliminate overlapping projects, or just reduce their number or scope in order to optimize innovation activities. Sometimes, the other company might already have a solution for the research project or strategic priorities will change. Administration. Here is the point to eliminate overlapping employees, especially in cases when the target is a mature bureaucratic organization. On the other hand, potential synergy sources can be found at the revenue side as well. For example, cross-selling. Here is the point to bring products from your target to your own market and vice versa, increasing total revenues. Brand utilization. Here is the point to better exploit the benefits of owning, after the deal, additional brands. For example, you can scale them as mass versus premium brands, increasing the reach. Or you can extend your own product range. For example, in the fashion industry, you can add to your suit and shoes collection some accessories by adjusting just the acquired brand. Value chain extension. Here is another opportunity to acquire a specific target company that will bring you to the end client, meaning to supplement your current customer, allowing you to increase your own margins. Bargaining power increase. Here is the point to exploit benefits of economy of scale by pressuring customers to accept price increases. Of course, you should pay attention to potential drawbacks as well. Usually, in order to get corporate approvals, M&A professionals overestimate potential synergies, or they might pay too much attention to numbers and general strategy outlooks that overlook corporate culture and leadership style mismatches. If the buyer is a mature, bureaucratic company acquiring a young, entrepreneurial company, most likely there would be a lot of differences in culture and how the companies are run, causing a struggle in the process of integrating companies. That will be additionally explained in the last section. On the other hand, financial investors are also motivated to distill as much money as they can from an M&A deal, but as we have explained, they have a completely different approach. Instead of focusing on synergies, they are obsessed with making the target more beautiful and exit strategies. Although we are going to explain exit strategies in detail in the last section, here we are going to highlight few aspects. Making it sellable. Usually, when an entrepreneur decides to sell a business, this company is still very dependent on his own ideas and decision-making. Simply, he is involved in everything, making this company less attractive for some strategic buyers. And financial investors might have a significant role here to enter timely and help in the process of introducing professional management by hiring a reputable CEO, establishing few managerial layers, introducing some elements of bureaucratization, like reporting, budgeting, and long-term planning systems, incentive systems, etc., and so on. Simply, they help in the process of separation between ownership and management, or governance, making the entrepreneur irrelevant for the future of the business. Performance improvement. Here is the point to make financials look better through a series of initiatives. Income statements, meaning sales, EBITDA, and net profit, are boosted, and balance sheet items, meaning assets and capital structure, are rebalanced. That might include restructuring measures and selling some assets not relevant for core operations, or merging the company with others in order to make it more attractive. Making it more visible. Here is the point to improve branding in general, and to launch talks or rumors about how amazing a company is among potential buyers and intermediaries, meaning investment bankers and other advisors.